All right, thank you. Kevin Flager, Managing Director of Investments. I have a couple people from our team here I want to introduce. Marcus Henderson in the back, waving. He's the one that prepared all these beautiful charts for us today. So if there's a mistake, please see him. Karen Minen, one of our portfolio managers with the dark hair. And in the back, Gary Dyer, Senior Portfolio Manager. He's going to join us up here and give us his thoughts on Brexit, one of the new and very big developments in the last couple weeks. Just before we get started, we're going to cover kind of what happened the first half of this year, and we're going to also cover what we expect for the second half of the year, and then we're going to kind of give you a broad update on what we expect from Brexit. Gary's going to handle that part, and then I'll wrap it up at the end, and we're hopefully going to have time to take some questions if anybody has any questions. Okay? First of all, who has an investment portfolio? Great. Prospect. Also, who attended our Outlook meeting that we had for 2016, the one we had in January? Anybody? Okay, because I'm going to contradict myself on a couple of those things I need to know. Who's going to see that? All right, good. First of all, let's talk about the stock market. That's really what everyone is thinking about. And if we look at the stock market, how has it done this year? Right.
Kevin, I want to stop you real quick. One housekeeping thing I forgot. This presentation is in your folders on the that you have on the table in front of you as well.
In case you can't see it. Stock market's done okay. We're up, through the end of June, we're up about 3.8% on the S&P 500 index, which is, not bad. But that really hides the fact that it's been a very volatile 6 months. We started January and the first part of February kind of going straight down. We had a 14% correction. And if we look at the last time we hit an all-time high was May of 2015. And, that's now 14 months we're working on. That's an unusually long time to have no new all-time high without having a recession. So we're kind of in unusual times. Not only did we have the correction early this year, remember we had a correction last fall, around that August, September, when we really started to see the oil price crater and we thought the Fed was going to raise rates, more aggressively. We're going to talk a lot about that. But so even though in 14 months we were pretty much flat, we've had two official corrections of more than 10%. So we certainly see that there's a lot more volatility, and you can see those pretty clearly, and kind of flat over that time period. So let's talk about what's causing these things to happen and what we can expect. The way we measure the economic growth is GDP, or gross domestic product. And if we look at GDP, we can see since the last recession, we're averaging about 2%, okay, which is okay. Anybody know what the normal rate is, the historical rate on GDP growth is? 3.5%. So we're used to growing about 3.5%, and if you kind of look at what we did, back here in the early 2000s, we averaged around 3.5%, and rarely did we go below 2%. Well, now 2% is the normal. It's the new normal. So something is going on that's causing us to have slower than normal growth, and we have to kind of understand that if we're going to invest around this economic growth. We have a couple of things in the economy that are going particularly well. Jobs numbers, non-farm payroll growth. This is something that has been one of the standouts for the economy over the last couple of years. We have averaged over 200,000 net new jobs per month, which on an historical basis is actually quite good. Anytime we can do that, we normally get above average growth, like that 3.5–4% GDP growth. But we're not seeing that this time around. Even though we're having good growth, we're having what I would call lower quality job growth than we're accustomed to. Then on top of that, we've had a decline recently, and I think everyone knows that we have 3 straight months of a drop in the jobs numbers. And last month, for the month of May, it posted only 38,000 net new jobs. So when we're averaging 200,000, for pretty much all of 14 and all of 15, and then we go down to 38,000, there seems to be a problem. One thing, that's causing that is GDP in the first quarter. Anybody know what GDP was in the first quarter? I know you know. 1%. Well, we actually had a real slowdown in the first quarter due to a number of factors. So we know we had some slow growth there, and hopefully we're coming back from that. In the second quarter, we expect about 2.5%. So still a nice improvement from the first quarter, from 1 to 2.5, but still only about that new normal pace, not back to historical levels in the 3s. So we're going to keep a close eye on this, and what's important is the jobs numbers actually come out on Friday, this coming Friday, tomorrow, and for the month of June. And that's going to be the first really good indication that we have as to whether we're going to continue this really negative trend that is something worth watching closely, or if we're going to rebound. The consensus estimate right now is for 175,000. So most economists are expecting a nice bounce back from last month's number and really reverse a lot of that negative trend. That would be a really good thing. If we look at other things, for the economy and how it's doing, I picked housing starts to show you just because this is a real kind of microcosm of what's going on in the whole economy. It's recovered, but it hasn't recovered enough or as fast as we would like. Housing starts is simply the number of homes that were started under construction during a certain month. And during the recession, we saw that number drop all the way down to under 500,000 homes per year. Now, before the recession, we were averaging 2 million new homes that were started each year. So when you go from 2 million to 500,000, lose 3/4, that's going to have a big impact on the economy, and it has. The good thing is we've recovered very nicely. We're up to almost about 1.2 million. So from 500,000 to 1.2 million, a really nice recovery. But it's important to note, we're probably not going to get back to 2 million homes per year. We're probably going to top out around 1.5, maybe 1.4 million. So we are getting close to kind of our equilibrium rate on housing starts. It's been a very slow, very gradual recovery in housing, just like the rest of the economy, but we are making progress, just like everything else, it seems. And one more thing I want to look at, consumer price index. This is something that's important because the Fed watches the inflation numbers very closely, and that's how they determine how they're going to adjust their short-term interest rates. They look at employment and at inflation. And one of the measures of inflation that we use is CPI. Anybody know what the Fed's inflation target is? Anybody know? 2. There you go. Who said it? 2. 2% is right. That's what they're trying to target, and they want it to be, at this point, at least 2%. Okay, they would like it to be over a little bit more than under. And you can see this is the year-over-year growth. It shows that while we're at 1%, it wasn't that long ago we were at 0. And it actually took a giant dip starting in 2014. Anybody know why it dipped so much in 2014 and 15?
Oil.
What's that?
Oil.
Oil, exactly. The price of oil started, diving like it fell off a cliff in 2014. Remember, we were over $100 a barrel and got as low as $26 a barrel. We're going to cover that a little bit later. So obviously, when one of your major inputs drops by 3/4, you're going to find that it affects the average price paid for consumers. So the good news is we're kind of making a comeback, and I think that's something worth watching. The Fed is watching that very carefully. All right, so let's talk about what things that we expect for the next 6 months, the remainder of the year, and kind of how those things have changed and how they're going to affect the market. And this is what is going to guide what the stock market does, I think, for the rest of the year. The first thing that we see is that there's a strength in the dollar. Okay, that dollar strength has been one of the factors that caused the stock market to sell off in January and in early February. And you can see just by looking at this chart that at the same time that oil started shooting higher, oil started shooting lower, the dollar, the value of the US dollar started shooting higher. And by the way, this is the dollar index compared to other major currencies, to a basket of currencies. You know, the yen, the euro, Australian dollar, etc. And based on that, we can see it moved up strongly from around 80 to about 100. Well, obviously, when you have the value of the dollar go up that much, it's going to have an economic impact, and it's pretty big. Anything that we sell overseas just got 25% more expensive. That's a big deal because those people that sell stuff overseas are now less competitive, other things being equal. So if they're selling a Ford truck, you know, to Europe, it pretty much just got 25% more expensive. They're going to sell a lot fewer trucks, right? Now, one thing that we see is it topped out around January. This number is at the end of last year and early this year. So when the dollar was topping out is when we started kind of declining, and it really affected our stock market. Remember, we lost about 14% to start the year. One of the reasons is the dollar. And we're going to talk about why that dollar went up that much in a little bit. Nice thing is we've come off the top. You know, we were over 100 at one point, considered par. We dropped down to about 95. We're about 96 now, and we expect that level to kind of continue because we think the Fed is much more in tune with what the dollar is doing and how it's affecting the economy. There was a time where they didn't care. We're just going to go about our policy. We don't care what happens to the dollar. But we think they've learned their lesson on that. So dollar strength, something that hurt us early in the year, it's not as bad as what it was. That's really the point. It's better than what it was when we started the year.